sharpen up now. Okay, so let me just quickly give you an idea about your notes. Some of you might find this a little bit confusing, so let me just make everything, let me just clarify this for the moment. I will change the labeling, that will make it much clearer. Okay, first what you need to focus on is this NSE trading project, the core theory. So what I've tried to do here is, see, in our introductory module is on economies and markets. Okay, so in the longer version of the notes, so now we are dealing with a longer version and a shorter version of the notes for that particular module, economies and markets, which is the most important, the starting module. Okay, which is what you see here. All right, so this one starting initially with giving you the rationale for the curriculum, but essentially this whole thing starts with economies and markets. Somehow this is a little frozen. We go quickly to this economies and markets model, which is the first module essentially for your, it's an introduction to financial markets, okay, where you need to pick up a lot of the basics of financial markets before you do any of the project trading and out. So there are going to be two versions of this module, okay. One is the longer version of the notes, okay, which I will organize very quickly. So the part which is about the rationale for the curriculum, this part I will reorganize into Unit 0, which essentially is just telling you why I've designed the curriculum the way I've designed it, okay. And then we will have Unit 1, and Unit 1 will have two versions, the long version and the short version, okay. So the long version is obviously longer, and so initially what we wanted to focus on, which the one which I'm calling the NSE project right now, the core theory, this will essentially become what we call the short version, okay. So this will become the short version of Unit 1. Are you guys following? Of Unit 1 will be economies and markets, and this will become the short version. Why do we have a short version? Because we hope to be starting the trading project very soon, okay. Hopefully we'll get the IDs by 8th of July, and then we'll have 2 weeks of practice trading, you getting used to the software, because it's quite a complex piece of software. And then we will hopefully have 6 weeks of clean project trading, live project trading, okay. And that will end on 30th August as you go into your preparatory leave, okay, so that you'll finish your project and then you can prepare for your exams. All right, and I'll have the submission date after your exam, so you have, because there's nothing much, not much admin work involved in the submission. So that's the plan. We hope we can stick to the plan. So therefore the problem is that in order to do this project you need actually a lot of base knowledge, but at least absolute bare minimum core theory that I'm trying to put into the short version of Unit 1, which is the short version of economies and markets, because we don't have time before we start the project. We don't have that many classes to teach you the basic theory. Is that clear? And then later on, once we finish the project, once we start the project, I may go back to the longer version of the notes and cover some of that material, okay? So is this clear to everyone so far? So this thing, NSE trading project, I'll rename it as short version of Unit 1, okay? And then you'll have the long version of Unit 1, which is what you see here. And then I will create a separate for Unit 0, which is basically giving you the rationale for the curriculum, okay. So just briefly to give you the rationale for the curriculum, you can just look at it yourself as well, okay. You can learn another new big word here, a teleological perspective. What does teleological mean? Does anyone know? Yes? Okay, so essentially teleology is concerned with design and purpose, okay. It's a very useful word to know. It's a big word, and it's a useful word to know because it has applications in your life as well. It's always concerned with design and purpose. So if you're making a chair, or if you're a carpenter making a table, one of the things I should ask is, what is this table going to be used for? Is it going to be a computer table? Is it going to be a teacher's writing desk, or whatever it is, okay? So if you know what the purpose is, it helps you to do that job a little better in a more effective way, right? So it's always useful to ask, when you take a teleological perspective on management education, what that means is that you ask yourself, what is the purpose of this MBA program? So especially when we are trying to design the curriculum, right? So when you're trying to design the curriculum, what happens in most business schools is there is a curriculum which has been going on. I mean, these courses that you see, IPM and FDRM and all this stuff, these things, even when I did my MBA in 1988, it was still called IPM, and it's still called IPM, and pretty much the same material is being taught, okay? The point is, how do you design it? So if you I want to take a fresh look at it, especially for the finance electives. So my idea is, I ask myself, what is the purpose of this MBA program? So, and that will help me to design what I put into the curriculum. Okay, so that's basically it. So there you'll see, you can go through this. I'm not going to spend too much time on it. So you can just go through this. And so essentially what I have done is, you will find that there is a spreadsheet in your notes. You can start looking at it if you have extra time. You will see that there is a spreadsheet here like this, okay, which essentially gives you the layout of the financial sector, the landscape of the financial sector. So here what I try to do is take a look at all these firms that exist in the financial sector, okay, and then try to look at their functions. Okay, so essentially I've tried to look at what you do, what each of these types of firms do. Everything is included here. This is an exhaustive list, including the government treasury. Okay, so we'll go through all of this when we go to our unit 2, okay, which is our firms and functions, etc. So we'll go through all this, but essentially this is organized like this. If you want, you can start looking at it just to get an idea. So everything is included here, okay, including the corporate treasury, the CFO's office, everything. And I've tried to look at all these different types of firms and what kind of roles they perform in the economy, okay, and the kind of skill sets that you need to perform these roles, that comes from the examination of the roles itself, okay. And so I've tried to design the program in such a way that you develop the skill sets that you would need to work in any of these types of firms which are performing this kind of function in the economy. Are you following? This is the broad idea. That's why you will find that, so essentially you can see all the steps here. Since we are going through this, we can go through it a little bit, okay. So when you compare notes with some of your friends from college who are also in MBA programs, you will find that the kind of material that we are covering in the finance electives, okay, could well be quite different from what they are covering, okay. And when you compare notes, also compare whether they are doing similar projects based on live data, etc. Okay, a lot of people use simulations. These are not simulations. What you're going to be doing, you're going to be working with live data, and so no one knows what's going to happen. Even I don't know what's going to happen. So, so the idea is basically the purpose of an MBA program: produce outstanding business graduate. Who are those? You take good business decisions. What is a good business decision? Okay, and then so far, I mean, the objective is to create finance students who take analytically rigorous business decisions in finance. And who faces business decisions? Okay, so when you start looking at, am I going too fast on this?
No, sir.
Are you following?
Yes.
Okay. So I just want to, in case you have confusions, that when you're comparing notes with your colleagues and with your friends in other business schools, you'll find that the syllabus here could be quite different, especially in the finance electives. Why is it different? I'm just giving you an idea behind my thinking, what drove me to select this kind of curriculum or design this kind of curriculum. Are you following?
Yes.
Okay. So I look at, so who is taking, essentially we have to take, you have to be prepared to take better decisions, okay, and solve the decision problems in a more analytically rigorous and effective way. So who faces decision problems? So it's the employees who are performing these finance focused roles in these types of firms, okay. Either you're working in a commercial bank or in an investment bank or in an asset manager, okay, or in a government treasury or in a corporate treasury. So I look at all these different firms and their functions, and I look at what kind of decision problems you might face if you were working in any of these firms. Is that clear? And so I try to design the curriculum in such a way that it helps you to solve these decision problems better. Okay, so that is the thinking that has gone into it. So that's why you'll find that even if you compare it to typical finance textbooks, you'll find that when you compare different finance textbooks which are used in MBA programs in the second year, you will find that they are all quite similar. But when you compare it to what the curriculum that I've designed for you, you'll find that there's a lot of difference. You'll find that I'm not referring much to your textbook at all, but I will refer you to certain chapters in the textbooks which you have to study on your own. Okay, so this is the thinking. So I just wanted to share that with you so that you don't have, so you understand where I'm coming from and what I'm doing, why I'm doing what I'm doing, right? Okay, so far everyone follows? Okay, not going too fast? Okay. So if I'm going too fast or anything, just please let me know immediately. Okay, so you can start studying this stuff on your own, and there are a lot of misconceptions that you will be able to clear up, because a lot of people use terms inaccurately. in the industry, like and among the trainers and people like the firms that you would have talked to for your courses, you'll see investment banking has become a buzzword in India. So one of the things you'll learn is what exactly an investment bank is. Okay, most of the time what they're doing is they're actually talking about M&A, and they call it investment banking, which is not correct. Okay, M&A and investment banking are quite different. So this will be labeled, this part, a very short note on Unit 0, which is the rationale for the curriculum. So I'm going to rearrange the notes like that. Okay, so having done that, let's go to your... Okay, and so we had this discussion here. Let's go to your NSE. Okay, so in the NSE Trading Project Core Theory, which is going to be the short version of your Unit 1, now we already did this part. The last segment of that is this discussion that we had the previous day. Uptrends, downtrends, and all that stuff, right? Okay, so here I tried to give you a very brief introduction to uptrends and downtrends, but actually the discussion of uptrends and downtrends is connected also to the discussion of cycles. Okay, so I'm trying to go in a little bit of a hurry here because I feel that there's a lot of material to be covered before you start the course. Okay, so we may actually go back and forth in this trends and cycles business. So what I've done is, what I will do here is let me put in okay, so let me put in this little bit of a hyperlink here so that when we go, because here we discuss trends. Okay, so we just very briefly discussed uptrends and downtrends. Okay, but what I will do, you have this, I think I've already put it in your, well, I don't want to scare you also. That's another reason that I, because some of the discussion on this trends and cycles is a little theoretical, and if you read the English part of it, you might find it a little confusing. But if you look at the pictures, it won't be so confusing. Let me see where the, yeah, cyclicality in asset prices. And so this is actually the long form theoretical discussion on trends and cycles. Okay, so I'll just briefly give you an idea of what, so here when we discuss trends, okay, uptrends and downtrends, now you know what an uptrend and a downtrend is. So the only other connection I would make, okay, is this, that if you look at this we can close now. We can keep this. Okay, so this is the note that I'm going to link to. So this note is already in your lecture notes. Okay, cyclicality in asset prices. Cyclicality is another big word, but it's very simple. All it means is the phenomenon of exhibiting cycles. Okay, so if you say that seasons exhibit cyclicality, if I make the statement seasons, which means all this autumn, summer, winter, spring, these seasons exhibit cyclicality because they keep coming in cycles. So you have a winter this year, then again next year the same winter comes back. Okay, the same type of season comes back. Okay, so that's all that cyclicality means. That is, something is showing the characteristic of appearing in cycles, okay, or moving in cycles. That's all that means, all that this means. So what I'm doing here is I am linking this note to this part here. Okay, more detail on trends and cycles. Okay, so all right. So we have a brief discussion we already had on the definition of uptrends and downtrends. Okay, and so if you want to have a more theoretical understanding of uptrends and downtrends and how they're a part of cycles, you can refer to this note. But as I said, it's written as a theoretical note, just to of course it's written in a way that is it's a slightly legalistic way of writing. So you may get a little confused if you read only the English, but accompany the study with reference to the charts. If you see it visually, it's not so confusing. It's quite clear. It's pretty simple stuff actually. Okay, so if we look at Okay, so if we just go to Fred. Have I linked to this website here, Fred, as one of your links? No, I haven't linked to Fred. So this is another very, okay, so we'll come to this. So please note that I put in one more, just a little bit of a digression, okay? You might see that I tend to jump a little bit between this point and the other point, okay? But if you get confused, please ask. Anytime something is not flowing smoothly, any discussion is not flowing smoothly, please ask, okay? Anytime that you have any confusion about this, I've not covered something properly, okay, you've not understood it, please ask. The net seems to be a little slow. Okay, so it's not even loading properly. It's not loaded properly. So this particular website is the St. Louis Federal Reserve Bank, which is a very good website for economics related discussions. Okay. It seems to be okay. See here, this one, very good. Instead of reading, all kinds of garbage here and there on the internet, read. You can refer. They have working papers. They have blogs and stuff. So you can read this. Very good website. I'm just going to put it here. You can put it in today's discussion itself. So here's another link for you. Very good, and lots of data. Lots of data that is available here. Okay, you can. Look at this data. Let me just give you something. Yeah. So that lot of economic data is available on this website. Very high quality data. It's being maintained by this Federal Reserve Bank, and you can also read their blogs and stuff like that. What is happening here? This is a network problem. So if I switch to my no, it's okay. So so this is not, we needed more data actually. Maybe we should have had federal funds rate. I should have gone with the federal funds rate. Okay, so you can already see this here. Okay guys, this is one of the most important interest rates in the world. Okay, this is the interest rate that you can all see the percentages there. Okay, this is the interest rate that the US Treasury is paying to borrow for this maturity, 10 years. Okay, this is the yield to maturity. You're all familiar with yield to maturity, right? So this is the yield to maturity on US Treasury securities. These are debt securities, okay, for 10 years. And you can see how that has fluctuated. So I was talking to you about cycles. So the other basic point that I would make, since I've linked you to that particular longer note on cyclicality, is that it's a very simple idea. You can see that by now you can see that almost every type of asset price and every type of economic variable, I'll show you some examples of economic variables, they exhibit cyclicality. You can see that now every asset price. By asset price we mean stuff like bond yields, okay, and stock prices, okay, currency exchange rates and things like that, okay. Everything, these are what we refer to as asset prices. So by now everybody is clear that these things exhibit trends and uptrends and downtrends.
Yes, sir.
Is everyone clear? Chug is not convinced. Chug is the skeptic. Okay, so it's not bad to be a skeptic. Okay, let's see how much data we have on this. So I don't know if they have good monthly data on this. The data seems to be quite, the data set seems to be quite limited. And on top of that are, okay, so a little bit here, you can see, so this is the dollar against the Swiss franc, okay? So what I mean to say is that you can see whether you look at a currency, whether you look at an exchange rate, or whether you look at a commodity price, like I showed you crude oil prices, okay, you can see crude oil prices were also moving in uptrend. In fact, this is a better, probably crude oil is a better way to show you what we were talking about, okay. Yeah. So you see now in this weekly chart of crude oil, which is covering a long period actually, from 1985 onwards. Now you can see that any asset price that you can look at, this is the commodity price, okay. If you look at it, you'll see that there are uptrends and there are downtrends. Is that clear? You can see that, and you can call up anything. You can look at all the stock prices that you want to look at. You will see this phenomenon. Okay. So what we are saying now is this: we are just adding a dimension of cyclicality. We are just adding another term. What we are saying is that there is a. That's why this DFF is a better example. Even here you can see. Everybody understands. You remember what the sine curve is? You remember in a sine curve you have a clean up and down movement. Okay. So if we have here, maybe we have a link to a sine curve. The sine wave, okay. So this is the idealized cycle. So that this is what we're learning a little bit. You will also, therefore, you're also going to be trained to look out for these patterns, okay, because you are going to find this is totally empirical. There's nothing theoretical about this, okay. So you see sine and cosine curves, okay. So just look we are just discussing either of the curves you look at. So you can see here that this is an idealized cycle. So the sine curve, cosine curve these are all idealized cycles, because you see that it is moving in the bounds are clear, constant, okay, and it's moving up and down nicely in a neat, symmetrical kind of fashion, okay. This is an idealized cycle, okay. You have access to this note, so you can generate this. This is already in your notes, okay. So you can access all the material over here. You don't need to write this down, but whatever. As long as you're clear about that, okay. So this is the idealized cycle. So can you see that in this kind of cycle, when we look at a cycle, we typically measure a cycle either from low point to low point. We say that it's gone up and then it has come down here. So either you measure from low to low or you measure from high to high. Either way is okay, all right. But you should mention what you are referring to, okay? Because especially when you look at financial markets and economic data, it's not going to be as regular as a sine curve, okay? This is a highly idealized structure. So, but this gives you the idea of the cycle, that there is, it rises from a point and then it comes back to that point, okay? This is the idealized cycle. So from here you get, and so what we are saying is that in any cycle consists of an uptrend and a downtrend. Okay, either the uptrend comes first or the downtrend comes first. If it's a high to high, then the downtrend comes first, then it's followed by the uptrend. This is clear? So all we are doing is we are adding another theoretical construct. We are saying that there are uptrends and there are downtrends, and there are downtrends which we studied the other day. Okay, and now we are going back. We are almost studying it in reverse. Ideally, what we should do is we should study from first we look at a cycle, and then we see that a cycle consists of uptrends and downtrends. But because I'm in such a panic about the time pressure, amount of material I have to cover, I was trying to focus just on the bare minimum you need to know. Okay, but I think this cycle aspect is also important to look at, because you'll see this feature in market prices as well. Okay, so is this clear so far? We are talking about an idealized cycle in the sine curve, but in fact what happens is in real life what happens is, you can see here even in the oil price. Now I did not draw this with my hand just to make it look like a cycle. This is real stuff, okay? This is real stuff that is going on, and you can see almost an idealized cycle here as an example, okay? That you have this uptrend, and then of course this part is not so neat, okay? And then going down. All right, so you can see cyclicality in all the asset prices that you look at. So therefore you will see this cyclical movement in asset prices, and then you will see, obviously, because if there is cyclical movement, there is an uptrend and there is a downtrend. Okay, and every time you look inside an uptrend and downtrend, you will find this pattern. There's a high, there's a lower high, there's another lower high. Okay, and then there's a low, then there's a lower low, another lower low, and so this kind of sawtooth pattern you'll find everywhere. Okay, and then of course you don't really know when that trend is going to get neutralized. Okay, so we say that when any of those lower high and low, okay, higher high and low, this pattern gets destroyed, we say that the uptrend or the downtrend is neutralized, okay? Or you can say it's no longer in progress or whatever. So this is what, but you do see that. One thing that is very clear is that you can see for long periods this kind of pattern persisting. So you do see clear uptrends and downtrends in market prices. And then you see this, obviously that is exhibiting, that is proof of a cyclical movement, cyclical tendency in market prices, okay? So what I was showing you here is that you'll see it almost everywhere. So this is not a neat cycle because it's kind of overbalancing to the downside, okay? And of course we don't have much data because this is starting from 1962. So if you go back to 1945, then it's more balanced. But even here you can see something which is, again, I didn't draw it with my hands. This is a plot of what interest rate the US Treasury has been paying on its 10-year bonds, okay? 10-year debt security. These are actually called 10-year notes, but essentially they are bond market securities, okay? Later on you will learn the distinction between money markets and bond markets when we do the understanding taxonomy of capital markets. Okay, so can you see the cyclical movement here as well? And can you see in the downtrend once again, high, lower high, lower high, lower high, lower high, this pattern is going on, okay? And it's not really been broken unless you look at the small patterns here. And this is the movement account. This is basically it. This is when you have the Trump election and there's a big jump in interest rates, okay? And now again it's coming back almost, it's down to 2%. So you can see this long, and you can also see all the historical data. And the gray part, can you see the gray parts? Okay, so the gray parts are recessions, okay? You can play with these charts. You have a lot of data on this website, enormous amount of data. You can keep playing with data, and this is all empirical stuff. All the stuff you see here is all real stuff, okay? How did interest rates move? Okay, so there's nothing subjective about this. This is how it moved, period. You can't have a second opinion on this, okay? You may like it or you may not like it, but this is what it was, okay? So another one which gives you a better indication of cycles. I think here the data is a little bit better. I mean, slightly more data we have. Yeah, this is from 1955. Now this is essentially this is what we call this is the equivalent of this is the US equivalent of what is the policy rate in India called? Do you understand monetary policy and fiscal policy, right? Who is going to explain the difference between monetary policy and fiscal policy? Saloni, tell us the difference. Give her the mic. What is the difference between monetary policy and fiscal policy? Voices, is it coming through the mic? Yeah, yeah.
Monetary policy is related to money matters.
But that's not good enough. You can't, as a finance student, you can't say obviously monetary policy is related to money matters. The Japanese economy is related to Japan. So give us more detail on what exactly monetary policy is. Who conducts monetary policy? Don't say RBI. I'm asking you a general question. I didn't ask you who conducts Indian monetary policy. I asked you a general theoretical question. Who conducts monetary policy?
Central bank.
Central banks. Now that is the right answer, okay? So at this level of abstraction, you should say central bank. So I didn't ask you who conducts monetary policy in India. Okay, so central banks conduct monetary policy. How do they conduct monetary policy? In the modern age, typically how do you see most central banks like the US Federal Reserve, the European Central Bank, the Reserve Bank of India, how do you see, let's just focus on, because those two other banks are using some other techniques. But in India, let's say, how does the Reserve Bank of India conduct monetary policy? What is the main tool of monetary policy in India? Is my question clear? Not clear. You are not clear as to what the main tool is. Okay, let's give it to Tanya.
It's the repo rate that the bank decides.
Okay.
The rate at which the commercial bank can lend money from the central bank.
Lend money from the central bank?
Take money from the central bank, and the reverse repo rate also, at which the central bank can borrow money from the commercial bank.
Okay, so yeah, so it's the repo rate that we call that we use in India. So it's in international markets it's called the repo rate. Okay, the way they pronounce it. It's a short form of repurchase agreement. Okay, so it comes from repurchase agreement, which we will cover later on when we do bond markets in detail. So essentially the policy, to the short answer to the question of what is the main monetary policy tool in India, the answer to that is the repo rate, okay? And essentially that pulls up the reverse repo rate as well. So when they change the repo rate, so that is the rate at which the banks can borrow. My mic just went out, but anyway, so we'll try to use, I want to prevent myself from shouting, so I would like to use your mic. It was already looking a little dodgy because the light had gone red. Okay. All right. So the main tool of monetary policy in India is the repo rate. Okay. Essentially, it's the rate. And what exactly is the repo rate? She already explained it. Okay. So it's the rate at which banks can borrow from the Reserve Bank of India. Okay. And this is a case of securitized borrowing. Okay. So they are borrowing using government securities as collateral, and sometimes the Reserve Bank may designate other securities which are also acceptable as collateral. Okay. But generally, the understanding is that when you are borrowing through repo transactions from the central bank, it is the collateral that you're going to be using is government securities. Okay, so what you're seeing on this chart is the US equivalent of the Indian repo rate. This is what is called the effective federal funds rate, okay, which is essentially a weighted average of, this is again the rate which is prevailing in US money markets for borrowing reserve funds. Okay, you guys have all done this concept of fractional reserve banking as a system. CRR, you know what CRR is? You've already done this, cash reserve ratio, right? So every bank, this is a system that is quite common to most of these Anglo-Saxon model economy, and even the continental European economies. Most countries practice, this is called the new term that you're learning, it's called fractional reserve banking. Okay, so we can write this down here as some of the things that we are covering. So fractional reserve banking, this is again a term. So if somebody asks you what is fractional reserve banking, sounds like a big word, but you already know what it is, okay? That in every country that follows fractional reserve banking, which is pretty much every country today, every developed country today, I mean developed and developing. So what you have, the scheme is essentially this, that the central bank is going to look at your total deposits, okay? So in India we use this expression NDTL. You heard this expression NDTL? Okay, NDTL is net demand and time deposit liabilities. So let's take the example of India. We have, okay, so the Reserve Bank is going to, my spelling may be a little off, SS NDTL. NDTL stands for net demand and time deposit liabilities, okay? All demand deposits and time deposits, NDTL. So what the Reserve Bank is going to do, and it's the same system pretty much everywhere else, you might call it something else, but in the US, in the UK, in Japan, everywhere else, it's the same system. They all follow fractional reserve banking. So the basic idea is always going to be the same. Even in Japan, the Bank of Japan is going to look at your deposit liabilities, okay? And you assess the deposit liabilities, and then you say to the banks that you can only lend out a certain fraction, or you say to the banks that a certain fraction of your deposits you must keep, you can't lend out everything. So if you've got like $100 million of deposits, okay, you can't make $100 million worth of loans, okay? You can make something less than $100 million, and that the part that you have to keep is the cash reserve requirement, okay? So we say this is the reserve requirement, okay? So in fractional reserve banking, you have something called a reserve requirement, okay? CRR is the reserve requirement. So this is something which the central bank can play around with, okay? So if the central bank wants to create an environment of looser monetary policy, a more relaxed monetary policy environment, are they likely to raise the reserve requirement or lower the reserve requirement? They will lower the reserve requirements, okay? So you'll notice what the People's Bank of China, because China is facing a lot of headwinds right now, the Chinese economy. So one of the things the PBOC has been doing, the People's Bank of China, is they've been trying to lower the reserve requirements as well, okay? They try many different kinds of techniques, but one of the things they do is they try to lower the reserve requirements so that there is more credit available to the economy, okay? So you should understand this term, and you already know the mechanism, but you know that now you learned a new term which refers to this kind of system, fractional reserve banking. And so essentially the idea is to try to remember the general ideas, okay? The general framework which you can apply in every country, okay? So that basically the central bank is going to assess the total amount at a point of time. So they will take a snapshot at a point of time and look at your total deposit liabilities, how much money the depositors have placed with you, and then they will put this constraint saying that, okay, certain X percentage of this amount you have to keep in cash reserves at the central bank. Okay, you understand that every central bank has let's look at your calc file. Okay, so most of these diagrams are already in your this is not okay. Let's try to use this. I'm just going to use this as a as a way to illustrate the idea of concentric circles. Okay, so forget about what's actually written on this page, or maybe we could just make a duplicate of this so that you don't have to imagine too much. Okay, so I'm going to write FRB, which is fractional reserve banking. Is that okay? FRB also stands for Federal Reserve Banks. Okay, okay, so CB so let's just have a few CBs so that I don't have to write too many. We're just going to have a few CBs. Okay, so we'll call this CB 3 and CB 4. Okay, and then on the outer circle you have okay, corporates, then you have all right. Okay, so this is just a schema now. This is already in your notes, so you don't need to take notes. Okay, this is why I rarely use the whiteboard, because I want everything to be available to you, whatever is being drawn on the board, right? So this is how this fractional reserve system works. I think you already are familiar with this. So you have a central bank, and then you have the first circle around the central bank, you have the commercial banks. Okay, so the CBs are the commercial banks. Okay, the first circle around the central bank. The idea is that this is a circle, and then you have the second circle around which is beyond the the commercial banks. There you have all the, if you use the language of law, all the natural persons and artificial persons. Okay, so corporations are what? Are natural or artificial? Artificial persons. Okay, and individuals are natural persons. Okay, so instead of writing corporate and individual, that would have been better to write natural and artificial persons. It is a more formal way of writing it. Okay, so this is so you have essentially, you've got one center and you've got two circles around the center. Okay, two concentric circles. So the idea is that all the commercial banks, okay, all the scheduled commercial banks, that in India we have this concept of scheduled commercial bank. These are essentially the banks which have been designated by RBI as participating in that system. Okay, so all the scheduled commercial banks will have, they have to maintain, those who want to be part of the banking system, essentially, you have to maintain an account with the Reserve Bank, okay, with the central bank. Is that clear? So every bank has to have an account with the Reserve Bank, and that account will have debit or credit balance, whatever. Okay, so now the idea, so what the Reserve Bank is saying, when we are talking about the connection between this, it's important to have the schema in your head. Okay, so in the first circle you have the central banks, and in the second circle you have the natural and artificial persons. Okay, so the idea is that if you want to connect this schema to the idea of fractional reserve banking, when the central bank says that you have so many deposits, have you guys already covered this material? Am I repeating it or what? So new stuff for you, right?
Yes, sir.
Okay, so if I'm ever repeating stuff which has already been taught, then please let me know. Okay, don't just sit there like that and watch, what is this guy doing, So, so please let me know, because I may not be aware of everything that's been taught to you. Okay, so when the connection between this and fractional reserve banking is, that in fractional reserve banking, the basic idea is at a point of time, the central bank takes a snapshot of your total deposit liabilities. Okay, so then the central bank says that a certain X percentage of that deposit liabilities you will have to maintain as a cash reserve, okay, with the central bank. Now, where do you maintain it? You maintain it at this account that you maintain with the central bank. So the central bank will see, and the way it works operationally is that they will take a snapshot at a point of time T0, okay, and usually they will impose the requirement as an average. You understand, when you maintain accounts with commercial banks, they have this concept of average quarterly balance, AQB, right? So it's, again, they're going to say on average balance basis, typically for the next fortnight. So if they take it as T0, so the T0, they see that you have $100 million worth of deposits, okay, and let's say the cash reserve ratio is 10%, okay. So then in that case, you have $10 million that you have to maintain for the next fortnight on an average average daily balance basis, okay. So you can miss a few days, but then the other few days you have to make up, so that you have, on average, you have maintained a daily balance of 10 million, okay. So if you go to a commercial bank treasury, every commercial bank will have a treasury department, and the treasury department will have typically a money market desk and a foreign exchange desk, okay. So on the money market desk, one of the important things that a money market desk has to do in a commercial bank treasury, one of the important functions is to make sure that this cash reserve requirement is being complied with, okay. So the money market desk will know what is our requirement for this fortnight. So once you hit T0 and the central bank, you have to report your deposit liabilities to the central bank, okay. So you've reported $100 million and you already know what the cash reserve ratio is, 10%, okay. So now you know that you have to maintain, because the money market desk at the commercial bank will have a minute-to-minute access to they will have an understanding of what they're maintaining with the central bank, okay. So now for the next T0 plus 14, this money market desk will be tasked with ensuring that they maintain that cash reserve requirement of $10 million average daily balance for this next upcoming fortnight at the central bank. Is this clear to everybody? Yes? Everyone is clear? Vaishali? You don't seem convinced. Are you convinced? Okay. You think the ratio is too high? 10%. Okay. Verma, you're following?
Yes, sir.
Okay. So Verma has done we should give Verma a big hand. Verma has managed to qualify after giving, and he put in a lot of effort. Okay, so I found it very encouraging. He put in a lot of effort and he was very anxious to make sure that he qualified. And he was the most serious of all the students who were trying to get in. So it would have been very sad if he didn't qualify, but he has qualified, so good. So anyway, so as I said, keep up the hard work, and this is what you need to put in a lot of effort, okay. So in fact, when I look at you guys, I see everybody looking very happy and relaxed. Actually, I want to see you looking much more stressed out, because you need to work much harder. So when you come in, your hair should be all over the place. You don't, like, when I see you guys, you should look much more stressed out. When I look at you guys, you look all very relaxed. Everybody seems to be, you should be on a war footing here, So the amount of material that you guys have to cover is a lot of material, okay. So I want to see you guys looking much more stressed out. When I see you, you look very happy and relaxed. Okay, so a little digression. Yes?
Just the place, my song place,
Nothing, never mind, let's continue, okay. So the message is that you have to work a lot harder, don't take it easy. This is a special phase in your life when you should be working on a war footing, okay. So there are a lot of material to cover, okay. So we had a little digression. Is this clear to everybody what the scheme is? So now you've learned a lot about the, so obviously I can't write down everything, okay, that's why you have the video, but you make sure that you understand, you play back the video, look at the chart, look at the schema, and now everything should be completely stamped into your brain once you finish the revision of this material, and it applies to everything else that we discussed. Everything should be completely permanently stamped into your brain. This whole idea of fractional reserve banking, commercial banks, central banks, treasury department inside the commercial bank, money market desk inside the treasury department, and one of the key jobs of the money market desk is to make sure that the cash reserve requirement is maintained. And how is it calculated? How does it operationally work? That you take the snapshot, then for the next fortnight maintain the daily balance. And how does this work? So this, why did we get into this discussion? One of the ways that the commercial banks can maintain this money market balance, okay? Maybe they've lent out too much money. Maybe they don't have enough money with the central bank in their central bank account, okay? So one of the things, let's say Citibank is running short, okay? So one of the things they can do is they can call up other banks. So you have what is called the interbank money market. In India, we call that the call money market. Okay, that is just an Indian expression. But really, what you have to call, if you want to use the general expression for that, you should say interbank money market interbank market for reserve funds. Okay, so therefore, I think we should put this thing down here. Reserve requirement. Okay, interbank. This is a very important market because the massive volumes which go through here. Interbank market. Okay, so this interbank market, essentially the players are all the money market desks of all the commercial banks. Everybody's playing with each other. Whoever has excess wants to lend, whoever has shortage wants to borrow, and they get together and they lend and borrow between each other. Okay, so this is essentially the interbank market. So these are the general terms that we want to use. We don't want to use India-specific terms. We want to use general terms because you're learning the theory at this stage, and you should be able to apply it to any situation in the world. Okay, so interbank market for reserve funds. So you have an interbank market for reserve funds. So essentially, what is happening is Citibank is short. They don't have enough money in their central bank account, but they find out that JP Morgan, and usually you have brokers also. Anytime you have a market, you could well have brokers. Okay, just like in India, you have a real estate market, you see many brokers operating there. Brokers are just trying to smooth the information flow. All the participants don't have all the information. The brokers are essentially kind of like conduits for information. So in the money market, you can also have brokers. Okay, so you'll see that when you go there into this, okay, I've shut that thing. But when you look at the listing of different types of financial firms, okay, you'll see one category called agency brokers. Okay, those are pure brokers who are acting as representatives of other primary players. Okay, essentially acting as agents for principals. So those are the brokers. They are listed there as well. So Citibank may either deal directly with JP Morgan. Okay, they may have a hotline. The banks also have hotlines between each other. So money market desk, if you go to the money market desk of a major bank, you will find they will have a major switchboard with lots of hotlines. So big banks would have hotlines to each other. So Citibank might just call up the hotline of JP Morgan's money market desk and say, I'm short, can you lend me 100 million or whatever. Okay, so then the guy will say, yes or no. Or Citibank could also get a call from a money market broker like a Tullett Prebon or Cantor Fitzgerald, one of these brokers. The brokers will call and say, okay, I have a bank who wants to lend. Do you have any interest to borrow? Okay, then the Citibank guy will say, okay, I want to borrow. So in this interbank market for reserve funds, they will be borrowing and lending. Are you following the scheme? Because everybody needs to show the central bank that I have money in my reserve fund. So essentially what will happen here is, if Citibank borrows, if let's say this is Citibank and this is JP Morgan, if Citibank borrows from JP Morgan, okay, what JP Morgan will do is they will just send an instruction to the central bank saying that please debit my account for 100 million and transfer it to Citibank's account. Because they have more than 100 million excess in their reserve account with the central bank. Are you following this? In the settlement instructions, when the JP Morgan will tell the central bank that I've done a deal with Citibank, I have lent money to Citibank, so please debit my account for 100 million and lend it to and credit the account of Citibank for 5 days, whatever the period of the loan is. Okay, are you following? Okay, so that ensures that for the next 5 days, that 100 million shows as a average balance of Citibank, not JP Morgan, because they've done the borrowing here. Are you following? Chuk, are you following?
Sir, why is central bank required to do? Why do we need to tell central bank?
How will it, because...
Are you talking about out of that 10%?
No. Suppose we have used this 10% calculation and we have found that for the next 5 days, Citibank is short 100 million.
But sir, how can it be short? for example, if you have 100 million deposits,
No.
required to maintain.
Sorry, those numbers, I have changed around the numbers. I should not have, when I say 100 million deposit, don't connect that to the next 100 million. So the figures I'm giving you as example are not, let's not say 100 million. In the borrowing transaction, let's just call it say 5 million. Then it'll reduce your confusion. Because we started with an example where the total deposits of Citibank is 100 million and they are required to maintain say 10% of that. Okay, so I think you're getting confused only because I gave the example of borrowing as a 100 million amount. That is just a casual amount that I cooked up. Okay, it's not meant to be related to the example. But if you want to relate it meaningfully to the example, which we should probably, and then let's make it 5 million. Let's say we are not borrowing 100 million, we're borrowing only 5 million. So I'm 5 million short for the next 5 days. So Citibank wants to borrow 5 million from JP Morgan, and then JP Morgan, after the borrowing transaction is done, one of the settlement instructions they'll have to send is to the central bank, because these are the guys who are maintaining the account. Otherwise, how will the transfer take place, right? If I have agreed to buy a house from you for 3 crores, I have to give the instruction to my bank account saying that please transfer 3 crores to Chug's account. Otherwise, how will the transfer take place? So the instruction has to go to the person who is holding the account. I mean, where the account is domiciled. Are you following operationally how it works? Because the accounts are maintained with the reserve, with the central bank, right? So when you do a money market transaction, you have to give instructions to the central bank saying that please debit my account and credit the borrower's account. This is clear. Otherwise, the transfer will not happen. This is clear to everyone. Yes, are you following?
Yes.
Okay. So this is what is happening now. Obviously, so far everyone's clear. Okay, interbank market for reserve funds. Okay. So now, obviously, if you borrow money, what do we have to? Is there something else we have to negotiate? Interest rate. Obviously, there has to be an interest rate. Okay. So what you're seeing is this. This is the U.S. Main tool of U.S. monetary policy for a long time actually, and currently it is the main tool of U.S. monetary policy, which is the target for the central bank looks at a target federal funds rate, and this is an effective rate which is inside that target range. The central bank uses a range for federal funds, and essentially this effective federal funds rate is the rate at which it's a weighted average rate at which actual transactions have taken place in the US money markets. So you can see that of late they have been looking at rates around 2.5%. Okay, at which when these banks do, because these things have to continue happening. Okay, whether the economy is doing well or poorly or whatever, these things have to continue happening all the time. So currently you can see that they're borrowing at around 2.5% when they have to do these interbank transactions in reserve funds. So this stuff is called reserve funds. Okay, this cash reserve requirement that is there in any central fractional reserve banking system. This the fact that you have, the money that you maintain with the central bank, the money that you are maintaining with the central bank towards the satisfaction of that requirement, that money is called reserve funds essentially. Okay, so this market for all the money that you maintain with the central bank is called a reserve fund. So either you have excess reserves or you are short of reserves, and then accordingly you will lend and borrow. So it's clear? Are you following so far? You've learned a lot of new terms and you should understand the whole schema. So everything is to be covered as one module. Okay, fractional reserve banking, monetary policy, main tools of monetary policy. In most countries there is some kind of at the moment main tool in most countries is this kind of a short-term interest rate, a money market interest rate. Okay, so essentially the Reserve Bank tries to control the rate at which banks will borrow reserve funds from each other. Okay, so that is basically how they maintain, try to control credit conditions. Okay, so one more thing that remember when you're studying all the material that you've covered, okay, try to organize it into modules. Okay, so that you have later on when you are asked in interviews, you'll have two types of questions. Okay, either there'll be questions from the blue, out of the blue, which you have no way of anticipating. Okay, so they may ask you whatever they want to ask you, right? And then there are and so either you can answer that question or you can't. Usually they will give you, especially if you've not been able to answer the first type of question, they'll give you an option say that okay, tell us what you've learned. Okay, tell us what you've studied. So when you get a question like that, don't give like broad answers like, okay, I've studied about stock markets or I've studied about financial markets. So what you should try to do when you get that kind of question is to give very tightly defined subtopics. Okay, so if you say, for instance, you could say, I've learned about fractional reserve banking. So that becomes like a subtopic, which is a reasonably tightly defined module. Okay, so in that, then they'll say, if you, what have you learned about fractional reserve? Then you can tell them, so you should have understood that topic very well. Okay, and then you can connect it to the idea for interbank market fund, I mean the interbank money market, okay, for reserve funds. Then how it's connected to the monetary policy, the conduct of monetary policy. Are you following what I'm saying? So this is this becomes a collection of small topics, okay, which are connected in some way, which is basically all connected to fractional reserve banking and how the interbank money market works and how central banks conduct monetary policy. So all these ideas you can give them in a discussion which is going to be similar to what we just discussed, okay, and then that becomes a module, and then you can show your expertise on that subject matter, okay, small subject area, and that helps you to make a good impression. If you give very wide topics like I studied about stock markets, so they might ask you some esoteric aspect of stock markets which you have not covered, then you're going to look like a fool. So don't give them, so when you're studying the material that you've been taught, try to organize it into subtopics which are kind of logically correlated to one another, okay. So like conduct of monetary policy is quite closely correlated to the idea of banks having to maintain reserve funds, because most of the central banks today are targeting that interbank interest rate, okay. So in India also we target the interest rate at which they can borrow reserve funds, okay. It's not the interbank interest rate, but they can borrow it from the central bank, but it's related to the same purpose, which is having to maintain reserve funds in a fractional reserve banking system. Are you following? Yes. Okay. So everything is connected. So try to identify ideas that are connected to each other and organize them into modules or subtopics, okay? And then, so when you do your review of your syllabus, organize and have these subtopics in your mind, that if you're asked in an interview, and master these subtopics, okay? And then make sure that when you're asked in an interview, if you are given an opportunity to talk about what you've learned, you give very well defined and tightly defined subtopics rather than broad answers like stock markets or bond markets and things like that. Okay, this is clear? All right, okay. So, so notes also, if you find, you'll notice that sometimes, see, what I'm doing here is that if I find that the material is not going to be within the natural flow of notes which I've prepared, okay, then I'm putting that material over here, okay, in this our session outline notes. So you'll have to jump around a little bit, and I'll try to organize the notes in a slightly better way. But this is basically the rule, that if it's not falling, because I want to make sure that the notes which are there with you, the lecture notes, they have to follow logically, they have to flow logically, okay. So I spend a lot of time just organizing the flow of subtopics. It must flow naturally. Okay, so we spend a lot of time on this, but at least it's good, it's important stuff that you needed to learn. So if you've internalized all this, that's good. So once again, we came to this chart because it shows you a very good example of cyclicality. Can you see that? Almost a perfect kind of cycle, okay, in something which is not really, like, I didn't draw this chart with my hand. This stuff has just been happening over the years, and as it turns out, it's traced out. This is actually an interest rate. This is almost like an economic variable, okay, because it's happening directly happening because of economic pressures, and yet you see how neatly almost a clean cyclical movement has been demonstrated here. And once again, you can see in a cycle, uptrends, downtrends, and any downtrend or uptrend, lower highs in a downtrend, lower lows in the uptrend, same feature, higher highs, higher lows. Is this clear? So does this give you a little bit more of a structure? Now, when you're looking at charts, you don't feel so lost, because you can start to identify cycles, you can start to identify downtrends and uptrends, okay? And you can start to see how a particular phase of the uptrend or downtrend might get neutralized, and then, okay, so like you can see here, there is an uptrend happening here so far, but then as it drops below this, okay, this is during the financial crisis, Okay, as it drops sharply below this high, you can see high, higher high, next high, low, higher low, next low, and then this drops below this, right? So it breaks, it kind of neutralizes the uptrend. Is this clear? Okay, so you can see that while there are uptrends, they also get neutralized. Okay, so it gives you a little bit more of structure to look at. Do you agree that with this idea of cycles and trends and the definitions of uptrends and downtrends, that it gives you a little bit more of a structure to with which to examine price charts? Yes? Are you convinced? Okay. No, you don't have to be convinced just because I'm saying it, but hopefully this gives you some kind of structure to put on market prices. Okay. So, so for instance, if you look at, so this is what we were looking at. This is essentially the whole discussion started from this last discussion that we had, and instead of just looking at uptrend and downtrend definitions, and I've also introduced the idea of cycles. Okay, and I've shown you some examples of cyclicality, and which you can see in the real world. And so therefore, and then we went into the long discussion on fractional reserve banking and the conduct of monetary policy. Let me try and show you something more interesting. Okay, let's look at, so far you could say that the two things that I showed you, the 10-year US Treasury interest rate and the effective federal funds rate, which is the money market, the monetary policy rate in the US, you could say that these are really more in the nature of asset prices, because they are market prices. Like interest rate is the market price of borrowing. Okay, but when we look at, is this actually max? Yeah. Now you look at this. This is the civilian unemployment rate in the US. Okay, so as you can see, whenever we have this kind of a crisis, this is the 2007 crisis, the unemployment rate shoots up. Does that make sense? Okay, because you have a recessionary environment, companies are not making money, they are laying off people because they're not able to sell products. Okay, so then the unemployment rate shoots up. Okay, previously also you had a higher unemployment rate. This is during the 1980 recession. But can you see cyclicality in this series? You can see it. Okay, again, it's not something that I drew with my hands just to make you look at the cyclical patterns, but this is again real stuff. Okay, this is the real unemployment rate. So they're actually one of the things you'll learn about the economy is that in the US there are actually 7 measures of unemployment. So this is actually something you can learn as well, that the unemployment actually depends on how you measure the base population, the denominator. So you can actually learn about the 7 measures of unemployment in the US. Okay, you can query that if you are curious about economic analysis. But this is basically this. I think this is called the U6. Okay, which is looks at basically all those people who are either working, and the denominator is either working or actively looking for work, or would be have stopped looking for work only for a few short period. So anyway, this is the unemployment rate. You can see this, and you can see how even something like the unemployment rate, which is a very purely economic variable, even that moves in cyclical patterns. And there also you see uptrends, and you see the same thing. You see uptrends and downtrends, and you can see the same patterns. Can you see that? Higher highs, higher lows. Okay, same patterns you can see. So therefore, this is a very useful piece of theory to be armed with, the idea of cyclicality and every cycle having uptrends and downtrends, and the definition of uptrends and downtrends being higher highs and lows, lower highs and lows. Okay, so so it's a useful structure to have in your mind when you're looking at market prices. Okay, so just to show you this, that economic variables also move in this manner. Okay, so okay, so we've covered this. Now what we are going to do now is essentially going to try and cover the okay, let's try and cover as much as we can on this. Okay, so we are going to quickly run through some definitions. Okay, it's organized in modules. This is your so the first thing I'm going to define is we're going to define a market. Okay, because these are definitions which will remain as clear technical definitions throughout your curriculum. All the material you cover, then we will never change this definition. Okay, so essentially we are just calling you can read this a little bit. Okay, but essentially for our purposes, a market is going to be defined as a venue for the exchange of two assets. Okay, and assets we are defining in a very general way. Everything is an asset. Commodities are also assets. Money is also an asset. I mean, different currencies are also assets. Okay, commodities are also assets. Bonds are also assets. Okay, equities are also assets. Everything is an asset. Okay, and so an asset concept of asset includes goods. Okay, all goods are assets, but all assets need not be goods. Some of the assets are essentially stuff like equities and bonds, equities and debt, which are not equity and debt securities, which are not really goods, okay, but in the layman's sense of the term. And so these are so the first definition that we encountered is a market is a venue for the exchange of assets. Okay, this will be useful to bring structure to lots of other complicated problems. Okay, so you can read through this definition here later on. Okay, if you have any problems, you can ask me. Again, you go through the notes. We are trying to cover it a little bit fast because we want to cover a lot of material. Okay, are you okay? Read this later on. But the first working definition here, the important concept here is that a market is defined as a venue for the exchange of assets. Okay, in a general way. Okay, so a financial market again is, so here, sorry, what we have defined is, okay, so in the longer version of the note, we say that a market is, I mean, the general definition of market is goods and services for money. Okay, but in the financial market context, we will only talk about as assets, which are going to include all goods as well, but we are not going to talk about exchange of services. Okay, so in the concept, two new terms we should learn today before we finish, okay, is this concept of base asset and terms asset. Okay, in every market there will be a concept of base asset and terms asset. This is what we need to learn, because what did we say, that a market is a venue for the exchange of two assets. Okay, so those two assets, we are giving them particular names now. We are calling one a base asset and one is a terms asset. Now what does that mean? Let's look at this oil chart, that will give you an idea. So this price that you see, 56.45, is a price for 1 barrel of oil. Okay, so in this market we say that oil is the base asset. Okay, West Texas Intermediate crude oil is the base asset. And what is the terms asset in this market? Anybody?
The price.
Price? No, price cannot be an asset. When you want, if you want to buy 1 barrel of oil, what will you have to give? Because everything is an exchange. Yeah, so US dollars. Okay, so the terms asset is US dollars. Okay, in this market, in the international crude oil market, the base asset is, in general terms, you can just say oil. Okay, but when you want to be very specific, you have to mention the crude, the grade of oil also. This is the West, because the price for Brent crude oil is different. Okay, so you have to, when you want to be very specific, you have to say this is West Texas Intermediate crude oil. Okay, the spot price of West Texas Intermediate crude oil is 56.46. Okay, and so here the base asset is crude oil, West Texas Intermediate crude oil, and the terms asset in US dollars. Okay, how would you remember this? The idea here is that the base asset is what is being priced. Okay, let's just complete these two important concepts. Market is a venue for the exchange of assets. There's two assets: base asset, terms asset. Base asset is the asset which is being priced. Okay, so if you're looking at the sugar market in India, it is the sugar that is being priced. Okay, so suppose it is, say, 20 rupees a kilo, then it is being priced as 20 rupees. It is the sugar price that is fluctuating, but it's always 1 unit of sugar that is being priced. The kilo is the unit over here. Okay, so it's always a particular market may be trading in quick kilos or quintals or whatever, but that remains fixed. So 1 kilo is being priced, and that price is fluctuating. So sugar is the base asset. And what will be the terms asset in the Indian sugar market? Rupees. Indian rupees will be the terms asset. Okay, so the base asset is basically what is being priced. Okay, and it's base because it never changes. So in the sugar market, you're pricing, let's say, 1 kilo of sugar. In the oil market, you're pricing 1 barrel of oil. So that stuff never changes. You're always pricing $1 barrel of oil. At one time, it may be worth $147. At one point, it may be worth $56. But the fact that it's 1 barrel of oil that is being priced, that never changes. Is that clear? That's why it's like a base. A base is something which is kind of fixed. It doesn't change. It's a base. So that's why we call it the base asset. Okay, that is the one which is being priced and it never changes. Yes, Rajan?
So sir, we use this for just for commodities market or every market?
Every market. Okay, that's why we are defining, that's why you'll see that the theory works in as general a way as possible. Okay, so we will use this for currency markets, for debt markets, for equity markets, for commodity markets, everywhere. It's a general definition of markets, a venue for exchanging two assets. The two assets are always going to be called base asset and terms asset. Base asset is the one that is being priced. And why is it being called the terms asset? Okay, just take 1 minute of your time. Why is it being called the terms asset? We'll cover it again next class, but try to revise it. Because it's in terms of rupees or in terms of rupees or terms of dollars that the base asset is being priced. How is crude oil being priced? Not in terms of Japanese yen, not in terms of euros, but in terms of US dollars. Okay, one barrel of crude oil is being priced in terms of US dollars. You're following the English language here? Okay, it's being priced in terms of US dollars. That's why US dollars is the terms asset. In India, the sugar market, 1 kilo of sugar is being priced in terms of Indian rupees. Sometimes it's 20 rupees, sometimes it's 40 rupees. This is clear? So what we've learned as additional progress on this module is market is the venue for exchanging assets. Two assets are going to be called base asset and terms asset. Okay, you can go now. I owe you 2 minutes and 40 seconds.